Kia ora koutou. Hello everyone and welcome to our series of interviews about the COVID-19 and particularly the business response to the virus now that we are in level 3, about to move into level 4 on Wednesday night. So my first interviewee is John Cuthbertson, the CAA NZ New Zealand tax leader, and I'm going to talk through with John the tax reform package that the government announced last week and also touch on a couple of other tax-related aspects of the response to the virus. So a very warm welcome to you, John. It's nice to see you over the Zoom. We normally sit quite close to each other in the office, but the last few days, obviously, we've been on home detention, so to speak, and we're now going to talk to each other over Zoom for the next month at least. So I'm going to ask you some questions, John, as I said, about the tax package that was announced last week, but before we get into that, I just wanted to start off with the wage subsidy, and the wage subsidy that the government announced last week, $585 per employee, per full-time employee, a somewhat lesser amount for a part-time employee, and the government extended that yesterday to ensure it was available to larger businesses as well as smaller businesses. So in the sense of how this package, this wage subsidy is treated for tax purposes, can you just talk us through how it's treated for tax purposes in the hands of the employer and also for GST?
Good morning, Peter. Thank you for that introduction. So for tax purposes, the wage subsidy payment provided to the employer as a bulk payment will effectively be non-taxable as excluded income to the employer, and will also be exempt for GST purposes. So on the employment side, the employer will not have to return anything in that respect. The flip side here, though, is that the employer will not get a deduction for the payment of the wage and salary in that circumstance for the government subsidy component, which is as you'd expect.
Thanks, John. What about from the employee's perspective? Is the subsidy taxable to the employee?
Yes, it is. So basically the subsidy just replaces part of their previous salary. So for all intents and purposes, it's just treated as part of their wage or salary, and normal deductions come from that. So PAYE, KiwiSaver, and the like. Student
loans, okay. So
yes.
What about the other part of the package that was announced last week, or another part, is the leave payment for self-isolation? How's that treated for tax purposes?
Quite similar to what I've just described for the wage subsidy. So basically the leave payments are obviously open to employees and self-employed. So as a recipient of a leave payment, that recipient would be subject to tax because it's basically replacing what would otherwise be income in any event. And like the other ones we talked about, it will not be subject to GST.
Great, thanks for clarifying that. John, we'll just move on to tax return filing. So we're approaching the end of March, which is the biggest date in the year in the tax calendar for our members and for all tax agents and for many of their clients. So what is the IRD doing in respect of tax return filing with all these tax returns due within the next couple of weeks?
So the IRD made some announcements last Friday. Basically, they can't extend the filing due date in terms of the current legislation. So tax returns will still be due on 31 March. That said, basically, however, they will not actively police tax agents' filing statistics. So if a tax agent falls below the 95% threshold of all their returns filed by 31 March, then that will not cause any issues for the subsequent years. It'll just carry on as normal. Inland Revenue have also extended, though, the ability for tax agents to what we call delist clients and their tax returns if there's not sufficient information. And the beauty of delisting is basically that any return that's taken off the agent's list by this mechanism doesn't count against their filing statistics. They have until 30 March to do that, and they can do that as a manual process on a IR provided spreadsheet, and they'll just give that to their tax agent account manager at IR. And that was sent out with the communications last week.
To tax agents. Thanks, John. That's good to hear that the IRD has taken a relatively concessionary approach to tax return filing, given where we're at and how this has happened at this time of year. If we then move on to some of the detail that was in the package last week, one of the things that the government has announced is that it's going to move the provisional tax threshold up from $2,500 to $5,000. So that will be of benefit, particularly to a lot of quite small taxpayers or small businesses. So can you just talk us through that one, John?
Yes, so basically I think you've covered off some of the key points already. Basically, the threshold's currently at $2,500 of residual income tax liability. That will increase to $5,000 from 1 April this year, which is the 2021 provisional tax year. The expectation is that that will drop about 95 to 97,000 taxpayers out of the provisional tax net. And a lot of those, as you mentioned, will be small business taxpayers. The beauty of that is that those taxpayers will then not have to pay provisional tax in 3 instalments throughout the year. And from a cash flow perspective, they will only have to come up with pretty much one tax payment at terminal tax date. So for a standard 31 March balance date taxpayer, the 21 provisional tax year starts 1 April. It means that the terminal tax is not due until 7 February 2022. So quite a deferral.
So that is quite a deferral. I suppose, John, the upside or the downside of that, depending on which way you look at it, is for the need for small businesses in that category to, if they can, and I appreciate that it's going to be very challenging, to put some money aside for that ultimate tax payment, because this is just a timing, a deferral issue rather than a permanent difference in terms of cancelling the tax liability.
Absolutely correct. I mean, yes, they will ultimately have to come up with the money, but it just gives them some breathing space now to put the money to where it's best needed in the short term, and then later on, yes, they will have to front up with the money. The reality may well be in this year, however, that a number of taxpayers will not be in a taxable income position and need to pay provisional tax.
Right, so you're making the point that this is a mechanism which will help businesses and profits, but it won't do anything for businesses that are in tax losses.
Correct.
Right. Okay, one of the other announcements the government made last week, John, was in respect of the low value asset threshold for immediate deduction. This is something I think we've been pushing for years, and it suddenly happened, which is a good thing. Can you just talk us through that? So what is it increasing from and to, and when will this happen?
Okay, so the existing low value asset thresholds currently set at $500, which, as a number of people have pointed out over the years, seems way too small. Effectively, from the 2021 income year, which is again within a week's time for standard balance date taxpayers with a 31 March balance date, that level will increase to $5,000. Unfortunately, that threshold increase is only in place for 1 year at that extended level of $5,000. And then in the 2022 income year, it will reduce down to $1,000. Still a bump up from the existing 500. Obviously, we would have liked to have seen it stay at the 5,000, but that's the current proposal.
Thanks, John. So how will this assist businesses?
Well, it's a shame it didn't kick in from this month. They've taken the opportunity to bring it into the next income year, which is only a week away. But it will certainly assist those business taxpayers who are having to set up their staff to work from home and are having to buy a number of smaller value items to do that, whether it be extra monitors or whatever to allow them to work from home. It does assist with cash flow. Because you get even though you're having to front with money now, you're getting an automatic deduction up front for tax purposes, rather than having to depreciate it over the life of the asset and have it drip feed out to you. So
good point, John. So it's businesses that have been able to buy equipment in the last couple of weeks for setting people up from working from home. They will be able to get that deduction up to that much higher threshold. Oh no, it only applies.
No, they won't, Peter. Yeah. Unfortunately, the way it's set at the moment, it only applies for new assets purchased on or after the next income year, which will be effectively 1 April for those with a standard balance date. Some of the early balance date taxpayers will already be in the new income year and will be perfectly fine.
Right. Standard balance date companies or businesses, John, it will be they'll be into the next income year very shortly, but they may, of course, not be able to purchase assets. They certainly won't be able to go out and buy them. They might be able to order them online if these businesses that are providing them are considered essential and the transaction can happen.
Yes, I mean, I think there'll still be mechanisms that they can get access to what they need. There is a definition of what's essential service that's been put up on the COVID-19 government website. And I think there will be a reasonable amount of flexibility in terms of being able to purchase. One point I'd like to make before we move on, Peter, is you've got to be mindful of the criteria for a low value asset. That hasn't changed. And basically, you can't exceed the threshold, whatever it is, on any given day in relation to purchases of equivalent assets of the same category and same depreciation rate from the same supplier. So you have to keep that aggregation factor into account when you're looking at the threshold, which will be $5,000 in the next income year.
Right. So nothing's changed there, John. That's not a new rule. It's just the existing rule carrying on through this crisis.
Yes, absolutely.
Right. Okay, and then we've got the reintroduction of tax depreciation on buildings. Again, another thing that we've been pushing for some time, in fact, basically since the removal of tax depreciation on buildings back in about 2010. So when will businesses be able to depreciate their buildings from, and how will this be calculated?
Okay, so I think the first step is to clarify which buildings this applies to. So basically, this is only going to apply to commercial and industrial buildings. It doesn't apply to standalone residential buildings. It will apply from the commencement of the 2021 income year. And again, I've sort of been harking back to what that might look like for a standard balance data, which for 31 March year end. So effectively, it'll apply from 1 April for those taxpayers, and that'll be their 2021 income year. It'll apply to both new and existing buildings. So in some cases, that'll be a reintroduction of depreciation for buildings where it's previously been turned off, and it'll be at the rate of 2% diminishing value. So basically, when you're looking at calculation, if you have previously depreciated, it'll be the tax net book value that you've previously had plus any capital additions.
So it's a permanent difference, John. It's not a temporary measure.
It's not a temporary measure. They have taken the opportunity to bring this back in. This measure, as you alluded to, was turned off from the 2012 income year, or from 1 April 2011, in legislation that came through slightly earlier than that.
Okay, well, that brings me to another interesting question, John. So these tax reform measures that were announced last week, they obviously have to go through Parliament. So they're certainly they're definite government reform proposals, but they must be signed off by Parliament. So how and when is that going to happen?
There's two different aspects to this. The subsidy stuff that we talked about first off this morning is Ministry of Social Development initiated, not Inland Revenue. That, the GST side of it, was actually enacted by Order in Council effective today. That's come out hot off the press this morning. The income tax measures, the 4 key income tax measures, they are to be legislated under urgency. We initially understood that was going to happen by around about the first week in April. With the potential close down of Parliament, it may well be brought forward. So it is expected anytime soon, I guess, is the short answer.
Yes. And the government certainly won't backtrack on it. What it might do is announce some other measures that would be added into the same legislative process, no doubt.
If anything, hopefully they may have listened to some of the comments and perhaps have slightly modified on the friendly side a couple of these measures in terms of what we've been talking about this morning.
Taxpayer friendly, that's good to hear. Okay, so that was tax depreciation on buildings coming back in.
Sorry, Peter, one point I'd like to make there, because it is a classic trap for everyone. When you're returning on the tap, if you like, for depreciation purposes here, I think tax agents and taxpayers need to be very mindful of how that depreciation is calculated. And the problem we've had in the past with a number of registers is that they don't like coming in through mid-cycle and altering a tax depreciation rate. Some registers will actually try and recalculate from the beginning. So you have to be mindful when you are changing the rate from 0%, which it'll currently be for these buildings, up to 2%, that it is calculating correctly and bringing forward the numbers correctly.
Thanks, John. That's a very useful tip. Okay, one other area which is outside the legislative process is related to use of money interest and the Commissioner's discretion with respect to imposing use of money interest on taxpayers. So can you talk us through how that's going to work in this situation, John?
Yes, so unfortunately this is going to be quite targeted. It will be a discretion for the Commissioner to write off use of money interest on late payments of tax in certain circumstances. And that's quite important because we've never really had too many discretions for use of money interest write-off in the past. So that's a positive. But basically, I said the relief is targeted. It's only going to apply to businesses or individuals who can show financial hardship and an inability to pay tax by the due date. It's intended to cover those taxpayers which is what they refer to as significantly adversely affected, and try and say that fast, from a financial perspective by the COVID-19.
There's likely to be a lot of businesses who are significantly adverse affected, John. So I suspect the Commissioner may well be inundated with applications for remission of use of money interest. Yeah,
so what we think that might look like, having a steer back to what MSD did with the wage subsidy, is a similar sort of criteria. So broadly, the businesses would be expected to suffer a 30% decline in revenue and have taken active steps by engaging with their bank or their financial advisor or their accountant. That's sort of the direction of travel we're expecting, and we'll obviously know fairly soon, once it's enacted, what that actually looks like.
Wonderful. Thanks, John. Look, thank you for talking us through all of the aspects of the package. Really useful for our members and their clients.
One thing I would say, Peter, is that's intended to apply for tax payments that are due on or after the 14th of February this year. And the expectation is that it's a temporary measure in the sense that it'll be in play for about 2 years.
Okay, so that's use of money interest. Thank you, thank you. So as also, John, take the opportunity to thank you and your team and the members of our tax advisory group, the CANZ New Zealand Tax Advisory Group, have been working very closely with John and the team to feed into, provide input to, and comment on, work with the IRD and Treasury who are developing these reform packages. It's really useful to have you right in the thick of that, John, and certainly I think we've encouraged members through the MyCA platform to feed in any ideas, other ideas, because there's certainly no shortage of ideas out there, I'm sure, on how the government could make further tax changes that will help businesses through the crisis. So encourage members to engage on MyCA and engage with John and his team about what any of those thoughts might be.
Thank you, Peter. And one final thing I would say to the members that are listening to this, we will now be putting up on the website and through all of our other channels almost a Q&A type approach. We've had confirmation from IR we can release the information now, and we'll be disseminating pretty much what we've talked about this morning, plus other examples onto our channels as soon as we can.
That's great, John. Thank you. Keep up the good work.
Thank you, Peter.